my name is Heather Culver and I'm an analyst here at Top Shelf Models. I'm currently in one of the multifamily development models, and I'll be using it to discuss capital expenditures and Capex reserves, as well as walking you through how Capex reserves are calculated in our model. Let's first dive into what capital expenditures are. In real estate, Capex refers to expenses incurred to create future value. These expenses are long-term investments intended to increase the profitability of a property in the long run, and can include things like upgrades to the property or material improvements. Capital expenditures can be used for growth or for maintenance of real estate properties. Some examples of maintenance-related Capex include replacing the roof or flooring and replacing elevators or HVAC systems. Two examples of growth-related Capex include tenant improvements and leasing commissions. As previously stated, expenses related to Capex are long-term, and therefore they are depreciated over the holding period of the investment rather than at the time that they are incurred. Now we'll get into Capex reserves. Capex reserves refer to funds that are set aside for future capital expenditures or long-term capital improvements to the property. To create a Capex reserve, an amount of money, usually on a per square foot or per unit basis, is reserved monthly or annually. Capex reserves are sometimes required by lenders. For example, a lender may require that a multifamily investor budget $25 per unit monthly to cover future improvements to the units. Capex reserves serve as a way for investors to reserve current cash flow so that they can fund future property updates and material improvements as needed without having to call capital or make equity contributions into the investment. Similar to project management fees, Capex reserves are expenses incurred at a property that are unrelated to daily operations. Therefore, Capex reserves hit below the line, which means that they're not included in the net operating income of a property. We'll now get into how we calculate Capex reserves in our model. We first start on the Assumptions tab in our Operating Assumptions box. As you can see, cell G27 is blue, which indicates that it is an input cell. In this cell, you input the per unit annual that you want. From there, cell H27 calculates the amount per month that'll be reserved per unit at the property. From here, Capex reserves are calculated on a monthly basis in our Monthly Cash Flows tab on row 60. As you can tell, this is below the line. In order to calculate the monthly cash flow for Capex reserves, the model multiplies that monthly per unit amount from the Assumptions tab by the number of units that are leased that's located up here in row 30. From there, the Capex reserves, project management fees, and net operating income are summed to find the cash flow after vacancy and reserve. Thank you for watching. If you have any questions about capital expenditures, Capex reserves, or how they're found in our models, please feel free to reach out.